Every now and then I like to talk about economics. I like to mix it up a little bit here. And I figured you guys really want to know about this. This is an important discussion. Wall Street has announced that they are prepping for layoffs. And apparently these layoffs are going to be the biggest since 2008. Now, I want to give a quick shout out here to Case Study QB. He's always doing the damn thing. I want to show this video clip here first. And then I have an article that I want to show you as well, because we really need to be prepared for this. Anytime we start to hear that Wall Street is talking about layoffs or any type of economic failure coming our way, we need to keep our eyes and our ears open to this type of information. So here we go.
The New York Post reports that Wall Street is preparing for its biggest round of layoffs since 2008. Scott Shellady joins me. What's this going to do to the economy, all these layoffs across the board?
Well, you know, Stuart, the first thing people say is everybody overhired after the pandemic. And I think that's a load of garbage, because it doesn't matter why they hired or overhired.
What is this guy wearing? I just realized this, like, you know, when I listened to this before, I wasn't really paying attention to the visual per se, because I was kind of listening, but I'm like, what? WWE villain? I just noticed this, like, what is he wearing? Oh, no. Huh. Okay, sorry.
Layoffs since 2008. Scott Shellady joins me. What's this going to do to the economy, all these layoffs across the board?
Well, you know, Stuart, the first thing people say is everybody overhired after the pandemic. And I think that's a load of garbage, because it doesn't matter why they hired or overhired. All we know is that they see something coming that maybe the Fed doesn't see coming, or at least the administration for sure doesn't see coming, and that's a bad economy.
I just want to pause there for just a second, because he said that people overhired during the pandemic or after the pandemic. But if that's the case, then why are there all these vacant positions? I could go down the street right now to the Dunkin' Donuts, and I guarantee you there's a now hiring sign. Same thing with the Starbucks. Same thing with the Chipotle. These are all in the same plaza. Same thing with the Chipotle. Any business I go to right now, at least here in Massachusetts, there's a now hiring sign. So if that's true that they overhired after the pandemic, then why are there all these vacant positions? I think we should question that. All right, let's go back to I don't know why, you guys. I see you guys saying in the chat, why is he dressed like a cow? I don't know what's happening here. I really don't know. I've never seen a suit like this before. I've never seen a cow suit. Like, is this like a cow blazer or something? I don't know what's happening here. Let me go on.
They see something coming that maybe the Fed doesn't see coming, or at least the administration for sure doesn't see coming, and that's a bad economy. And if you have to fire all those people, I mean, look, your own Microsoft, I know how much you like it. When they're having to fire people that actually program and write code, that's not good. And I think that's you're firing people that are going to be making the money for some of these banks. So I often wrestle with the fact that a lot of these layoffs have not come through in these jobs numbers yet. But I'll tell you right now, if I have to listen to the Wall Street or I have to listen to Amazon about what they see with their management systems coming around the corner when it comes to the economy, I'm going to trust them more than the administration or the Fed, because these people have skin in the game, Stuart. They have skin in the game. They want to be able to make money and stay solvent, where the government really doesn't have to act as fast as they'd like, and the administration can just outright ignore it.
Yeah, I don't know about the outfit. It is very distracting. I'm not sure what's really happening there. But to that point, notice that they mentioned Microsoft. This is what I was telling you guys about before, that Microsoft, Google, Amazon have announced that they've laid off thousands of workers. So the tech industry is laying off people heavily. I think that's something that, at least for friends of mine that have tech jobs, they did not see coming. And I think they thought they were pretty secure in those positions, the software engineers, the computer programmers, but apparently that is not necessarily the case. If you're laying off the tech industry, I wonder where they're going to go. I guess they can go towards like other startups, maybe. I don't know, but thousands of people they're laying off. And so I do want to go to that New York Post article.
Wall Street is preparing for its biggest round of layoffs since.
I don't know why that started again. I want to dive into that a little bit deeper. So it says that Wall Street reportedly preps for the biggest round of layoffs since 2008. So I told you we're going back there again. Sabby don't like. So let's go on. Banks are preparing to lay off tens of thousands of workers in an industry-wide bloodbath that's expected to become Wall Street's largest since the 2008 financial crisis, according to a report. I sincerely hope more people are talking about this, because this is scary. This is very scary. The banks are preparing to do so. So when the banks get hit, you need to be concerned. The mass firings are looming after banks built up their workforces over the last 2 years as mergers and acquisitions, initial public offerings, and SPACs flooded in. Now, it says that the mass firings are looming after banks. Guys, you pay attention to the vocabulary here. See, in this paragraph, it says the mass firings, but in the first paragraph, it says layoff. Which is it? Are they fired or are they laid off? Come on, New York Post. Which is it? Are they being fired or are they being laid off? Those are two different things. I want to point out they're not the same. It's not the same. One of these things is not like the other. The mass firings are looming after banks built up their workforces over the last 2 years as mergers, acquisitions, initial public offerings, and SPAC flooded in. At the same time, most banks had halted their annual culling of 1% to 5% during the pandemic. Now, some banks are facing investment banking revenues that have been cut in half, even as payrolls have ballooned. You know whose pay has not been cut in half? The CEOs. The CEOs, I'm sure they're not losing any pay. I'm sure they're not having any pay cuts. I think they'll be okay. I think they'll be all right. Goldman Sachs, Morgan Stanley, Credit Suisse, and Bank of New York Mellon have already slashed more than 15,000 jobs combined over the past few months. Now, that is coming from the Financial Times. By the way, guys, I'm subscribed to them. You should do so if you can. I think it's like $1 a month or something like that. $1 a week or $1 a month. Might be a month or whatever. But they have some pretty interesting information on there. 15,000 jobs, you guys. This is insane. Those cuts could be just the beginning, according to some industry insiders. Banks hired in a crazy fashion over the last few years. That's coming from John, who's the CEO of recruiting firm Brute and Smith. So far, these layoffs have been normal retrenchment, but things could get worse. All right, so we're warning you now. This is why I'm warning people now. It says here, David Solomon, who's the CEO of Goldman Sachs, slashed 3,200 jobs just this month alone. So Goldman Sachs, which is often seen as one of the more aggressive banks when it comes to slashing its workforce, cut roughly 3,200 employees, or 6.5% of its employee base earlier this month. A move that could also be putting pressure on other banks to follow suit. Other bank executives are being asked, do we have our head count? I told you guys, I've been living here for too long and I'm starting to lose letters in my words. I'm not kidding. Like, I catch myself every now and then, instead of saying order, I catch myself saying order. It's a Boston thing. Do we have our head count at the right level given economic conditions? Although Goldman cut a similar amount of staff following the financial crisis, the size of the bank was closer to 33,000 employees, far smaller than the nearly 50,000 employees Goldman had just 1 month ago. Last month, Morgan Stanley axed roughly 1,800 employees, closer to 2% of its global workforce. The company's CEO, James Gorman, said the bank was frankly a little overdue for a trim since it hadn't done anything for a couple of years. Well, that's interesting. Okay. It hadn't done anything. Okay. Bank of New York Mellon, the Financial Times reports, is making smaller cuts, getting rid of roughly 1,500 employees or 3% of its workforce. And that's this gentleman here. Bank of America CEO Brian Moynihan said there are no plans for mass layoffs. That's probably because Bank of America, I'll pull this list up for you in a second. Bank of America is one of the top 10 banks in the world. And most of the banks in the top 10 are from China. That's probably why. We'll look at that list again. Some banks have yet to announce any cuts. Bank of America CEO Brian Moynihan said the company didn't have any plans for mass layoffs. He also said there may be a slowdown in hiring, but nothing beyond that. They need to hire some people for those customer service positions. Customer service at Bank of America is horrible. Horrible. I tell you from experience. I used to bank with Bank of America. The customer service is terrible. I don't care if you go talk to them in person or if it's the customer service phone line. That's even worse that you have to go through. It is just not good. Bad Cookie said, make Bank of America great again. Oh, man. Citigroup has yet to address whether it will lay off employees, but its chief financial officer, Mark Mason, acknowledged where necessary to restructure. We do that as well. Credit Suisse will see the most dramatic cuts. The Swiss bank is cutting 9,000 roles from its 52,000 person workforce, or 17%, as the troubled bank tries to restructure. Of course, layoffs typically happen at the least convenient time for workers to find another job. No kidding. Who wrote this article? You have this horrible flood of quality coming onto the market, but who picks them up? That's coming from Thacker. He said this to the Financial Times. The buy side isn't there to hire these people this time. They just don't have the capacity. Whew. This is all too much today. Like, it gives me '08 vibes, man. It really does. That's why I was just like, when I heard this was kind of like '08, I was like, oh no. Now I want to go ahead and bring up that list again of the top banks in the world, because I think that's important. Let me pull this up. And I want to look at the global. I don't like looking at, we can look at if we want to, right? Top 10 banks in the world. We can look at the top banks in the US, but I want you to see this from a global perspective, because why did they do it like that? What in the world? Where did it go? Because I want you to see the wealth and how it is distributed. I'm very picky about what I show you, because some of these are not like, I like to just show a table. Okay, and let me share. All right, the top 50 banks in the world. We're just going to look at the top 10, because after that, it's kind of like who are these people and who are these banks? And what I want to show you here is the first column is the current rank, and the second column is the previous rank. So what it was before. Most of them have stayed the same. There's a difference with Bank of America. I do remember that one though. But the top 10 banks in the world. The first one is Industrial and Commercial Bank of China Limited. So that's 1 for China. 2, China Construction Bank Corporation. So that's 2. Agricultural Bank of China Limited is number 3. That's 3 in the top 10 that are from China. Bank of China Limited, number 4, that's 4. BNP Paribas SA is 5. JP Morgan Chase Bank is 6. That is the first US bank to crack the top 10. 7, Credit Agricole SA is number 7. China Development Bank is number 8. That's 5 for China. And then 9 is MUFG Bank Limited. So you see here, it's 9 this time around, but the year before, previously, it was ranked number 10. And then you have Bank of America that just, inches into the top 10 at number 10. And that's also for the US. So out of the top 10 banks in the world, 2 are from the United States. 5 of them are from China, from what I see. And you can also see that Bank of America in the previous year was ranked number 9. So it's actually fallen a spot. And we can scroll down and take a look at the other ones. The next time you see another American bank, it looks like Wells Fargo, and that's ranked number 17. But for most of them, China has most of the banks that are in the top 10. So this is just something you guys need to see. I want to show you something else too, but a very quick crash course about what happened in 08. So we're going to look at that really quick, because if we have this warning right now from Wall Street that, hey, guess what? We're about to do massive layoffs, then we all need to be paying attention, because what does that mean for the housing market, right? Like, how do we get here? So let's go ahead and take a look at just a quick crash course of what happened during the 08
Welcome to Crash
housing
Course
crisis.
Economics. My name is Jacob Clifford.
And I'm Adrienne Hill.
And we're going to skip past you guys. We don't really need to hear all that. There we go.
To explain what happened, first we have to do a quick explainer about mortgages. And you might already know this, but basically someone that wants to buy a house will often borrow hundreds of thousands of dollars from a bank. In return, the bank gets a piece of paper called a mortgage. Every month, the homeowner has to pay back a portion of the principal plus interest to whomever holds the piece of paper. If they stop paying, that's called a default, and whomever holds that piece of paper gets the house. The reason I'm saying whomever holds the paper rather than the bank is because the bank, the original lender, often sells that mortgage to some third party. And the reason I say often is because this happens all the time. I've had my house for 9 months and 3 different banks have had the mortgage. Traditionally, It was pretty hard to get a mortgage if you had bad credit or didn't have a steady job. Lenders just didn't want to take the risk that you might default on your loan. But all that started to change in the 2000s. And before we go further, a quick aside here. The story gets complicated fast, and it's a fascinating story, but we're trying to keep it relatively simple. So I've asked Stan if we could put some additional resources in the YouTube description. And Stan said yes. Thanks, Stan. Anyway, back to our story. In the 2000s, investors in the US and abroad looking for a low-risk, high-return investment started throwing their money at the US housing market. The thinking was they could get a better return from the interest rates homeowners paid on mortgages than they could by investing in things like US Treasury bonds, which were paying very, very low interest. But big money global investors didn't want to just buy up my mortgage and Stan's mortgage. It's too much hassle to deal with us as individuals. I mean, we're pains. Instead, they bought investments called mortgage-backed securities. Mortgage-backed securities are created when large financial institutions securitize mortgages. Basically, they buy up thousands of individual mortgages, bundle them together, and sell shares of that pool to investors. Investors gobbled these mortgage-backed securities up. Again, they paid a higher rate of return than investors could get in other places, and they looked like really safe bets. For one, home prices were going up and up, so lenders thought, worst case scenario, the borrower defaults on the mortgage, we can just sell the house for more money. At the same time, credit ratings agencies were telling investors these mortgage-backed securities were safe investments. They gave a lot of these mortgage-backed securities AAA ratings, the best of the best. And back when mortgages were only for borrowers with good credit, mortgage debt was a good investment. Anyway, investors were desperate to buy more and more and more of these securities. So lenders did their best to help create more of them. But to create more of them, they needed more mortgages. So lenders loosened their standards and made loans to people with low income and poor credit. You'll hear these called
subprime mortgages. I was waiting for it to get to the word, but yes, they gave mortgages to people that had low credit and low incomes. And you guys know how I feel about like credit scores. Like I feel like the whole credit rating system is a scam to begin with anyway, because if you don't have any credit, that means if you haven't taken out any credit cards or you don't own anything like that, if you don't have any credit, you technically have bad credit. Make it make sense. You technically have bad credit, right? And then if you make a couple of mistakes, depending on what those credit mistakes are, it can stay on your credit report for 7 years. And I've also said this before too, if you come back and you're able to pay off the debt that you owe, it still doesn't matter. It still stays on your credit report for 7 years. So it still impacts your credit. And that's why the whole credit rating thing to me, it's a hot mess. I'm fortunate. I don't have bad credit, but I will tell you one thing. It is very hard once you have bad credit to get good credit because it stays on the credit report for 7 years. Even if you paid it off, it's a hot mess. But yeah, she's correct. Subprime mortgages.
Subprime mortgages. Eventually, some institutions even started using what are called predatory lending practices to generate mortgages. They made loans without verifying income and offered absurd adjustable rate mortgages with payments people could afford at first, but quickly ballooned beyond their means. But these new...
Meaning the mortgages increased. I want to add that in there for people who are not aware. You have a mortgage amount that you can afford maybe in the beginning, but over time, the mortgage would increase. There's a documentary about this called The Con. Definitely check it out. I think you can stream it on Amazon Prime. It might be still on there, but they go through this, a whole documentary, different episodes where they talk about exactly what happened.
Subprime lending practices were brand new. That meant credit rating agencies could still point to historical data that indicated mortgage debt was a safe bet. But it wasn't. These investments were becoming less and less safe all the time. But investors trusted the ratings and kept pouring in their money. Traders also started selling an even riskier product called collateralized debt obligations, or CDOs. And again, some of these investments were given the highest credit ratings from the ratings agencies, even though many of them were made up of these incredibly risky loans. While the investors and traders and bankers were throwing money into the U.S. housing market, the price of homes in the U.S. was going up and up and up. The new lax lending requirements and low interest rates drove housing prices higher, which only made the mortgage-backed securities and CDOs seem like an even better investment. If the borrowers defaulted, the bank would still have this super valuable house, right? No, wrong. Let's go to the thought bubble. Actually, let's go to the housing bubble. You remember bubbles, right? Rapid price increases driven by irrational decisions. Well, this was a bubble, and bubbles have an annoying tendency to burst. And this one did. People just couldn't pay for their incredibly expensive houses or keep up with their ballooning mortgage payments. Borrowers started defaulting, which put more houses back on the market for sale. But there weren't...
One thing that she's leaving out that they do reveal in the documentary The Con is that some of these homeowners were people that already owned their home. So some of the people that were conned were people that already had paid it off or were almost there to paying it off. A lot of them were older people, elders, Black elders, people who they pretty much figured were not going to read through the fine print. They were also forging signatures for homeowners as well. By the way, none of these people went to jail. None of them, not one. So when you hear people get really upset at Obama and say you bailed out Wall Street instead of bailing out the American people, this is what they are referring to. The fact that those people lost their homes and Wall Street still got a chance to operate and function. Nobody went to jail.
Buyers. So supply was up, demand was down, and home prices started collapsing. As prices fell, some borrowers suddenly had a mortgage for way more than their home was currently worth. Some stopped paying. That led to more defaults, pushing housing prices down further. As this was happening, the big financial institutions stopped buying subprime mortgages, and subprime lenders were getting stuck with bad loans. By 2007, some really big lenders had declared bankruptcy. The problem spread to the big investors who'd poured money into these mortgage-backed securities and CDOs, and they started losing money on their investments. A bunch of money. But wait, there's more. There was another financial instrument that financial financial institutions had on their books that exacerbated all of these problems. Unregulated over-the-counter derivatives, including something called credit default swaps that were basically sold as insurance against the default of mortgage-backed securities. Does AIG ring a bell? It sold tens of billions of dollars worth of these insurance policies without money to back them up when things went wrong. And as we mentioned, things went terribly wrong. These credit default swaps were also turned into other securities that essentially allowed traders to bet huge amounts of money on whether the values of mortgage securities would go up or down. All these bets, these financial instruments, resulted in an incredibly complicated web of assets, liabilities, and risks, so that when things started going bad, they went bad for the entire financial system. Thanks, Thought Bubble. Some major financial players declared bankruptcy, like Lehman Brothers. Others were forced into mergers or needed to be bailed out by the government. No one knew exactly how bad the balance sheets at some of these financial institutions really were. These complicated, unregulated assets made it hard to tell. Panic set in. Trading and the credit markets froze. The stock market crashed. And the U.S. economy suddenly found itself in a disastrous recession.
So what did the government do?
Okay, and then we'll stop it there. I can come back to that video another time, but yeah, that's what happened. So Wall Street is laying off people. The banks are laying off people. Hopefully the housing industry is not affected. Hopefully it's not. But we'll have to wait and see. Probably not a good time to buy a home right now, though. Like, I'm not a finance expert, but probably not the best time to go buy a house right now. Just saying. All right. I'll take those comments on Rockfan and we'll move on to the next story. Thank you so much for the tip on Rockfin, Roger. This is the perfect opportunity for my vision of a government agency called Cooperative Business Administration that provide a pathway for startup co-ops to provide counseling, tax resources, a voice in government, government contracting, consultation, education, training, financing, research, all to make it easier to form business cooperatives from scratch or to aid in the conversion process when purchasing from the owner of a corporation, when applying right of first refusal laws. Public banks also to insulate your economy. Stop looking at glass half empty, people. This is a new beginning. Let's get them CBIs popping, people. It's January. We got 18 months to get them on the ballot and time's a ticking. Woohoo! Nationalize the banks or put them out of business with public banks. By the way, I'm in Massachusetts. If you're in Massachusetts, if anybody here wants to try to get something started for a public bank, email me. I am interested. Desert Mantis said, I'm voting Roger Meadows for president. I hear you, man. I hear you.